What if I told you that the country most people assumed was economically asleep for the last 30 years has suddenly woken up, and not quietly but with a move so powerful it could reshape global markets? What if I told you that inside a small, understated central bank in Tokyo, policymakers just set off a chain reaction capable of shaking Wall Street, destabilizing the US Treasury market, collapsing one of the world's most profitable financial loopholes, and reversing money flows that global investors relied on for decades? And what if I told you that most people want to realize what happened until the effects have already spread across the world? Because the truth is simple, Japan just pulled multiple financial triggers at the same time, not one, not two, but 6 interconnected actions that collectively marked the beginning of a global financial shift. The real mystery is why Japan suddenly took these steps now, after decades of caution, silence, and stagnation. That's the story we are going to unravel today. To understand what Japan just did, you must first understand the world Japan built in the first place. And to understand that world, we travel back to the 1980s, the period that historians call the height of Japan's economic miracle. Back then, Japan was not just growing, it was dominating. Tokyo real estate became so expensive that the Imperial Palace grounds were valued higher than all the land in Canada. Corporate giants expanded into America, buying Rockefeller Center, movie studios, prime real estate in Hawaii. Newspapers published dramatic headlines predicting that Japan would overtake the United States economically. The world was afraid of Japan's rise, but beneath the surface, a storm was already forming. Asset prices climbed far beyond sustainability. Banks lent money freely. Corporations expanded aggressively. And when this bubble finally burst in the early 1990s, it didn't simply hurt Japan, it froze it. The crash created a new and frightening reality. Banks were loaded with bad loans. Companies faced collapsing asset values. Consumers and businesses stopped spending. Growth evaporated almost overnight. In response, Japan's central bank, known as the Bank of Japan, began a series of extraordinary experiments. To save the economy, it slashed interest rates. Then it cut them again. Soon rates were near zero, but Japan didn't stop there. The central bank began buying government bonds at a scale never seen before. Later, it even began buying stocks and ETFs directly, something no major central bank had dared to do at the time. This was the origin of modern quantitative easing. Japan didn't just invent it, it perfected it. But something strange happened. Japan couldn't escape the system it created. Every time the Bank of Japan tried to raise interest rates, the economy stumbled. Every time it tried to reduce support, markets panicked. Every attempt to return to normal caused deflation, recession, or financial pressure so severe that policymakers backed off. What began as an emergency measure slowly became permanent. And as the years passed, the Bank of Japan trapped itself inside an economic loop. Interest rates stuck at zero for decades. Money printing becoming routine, and market intervention turning into a core part of the financial system. No other major country in the world maintained such aggressive monetary policies for so long. Japan became the outlier not because it wanted to, but because it felt it had no choice. But while Japan's internal economy remained stagnant, something unexpected was happening externally. Japan's zero interest rates created a unique side effect. The yen became the cheapest currency in the world to borrow. And when money is cheap, global investors notice. Banks notice. Hedge funds notice. And soon, the world discovered a new, incredibly profitable financial mechanism, the yen carry trade. Here's how it worked. Investors would borrow yen at extremely low interest rates. Then they would convert those yen into dollars, euros, or other currencies. Finally, they would invest that money into higher yield assets, US Treasury bonds, corporate debt, emerging market stocks, commodities, even cryptocurrency in later years. The difference between what they paid to borrow yen and what they earned from these assets became essentially free money. And because Japan kept rates low for so long, the yen carry trade became one of the most dependable, widespread financial engines in the world. This trade supported US stock markets. It supported the US bond market. It supplied liquidity to emerging economies. It helped fuel global credit expansion. And because the yen became the foundation for so much cheap borrowing, Japan effectively became the silent backer of global financial markets. The world didn't talk much about Japan, but it relied on Japan's monetary policy every single day. But at the same time, this system created a massive imbalance. The more the world leaned on cheap yen, the more vulnerable it became to any change in Japan's monetary stance. As long as Japan kept interest rates low, everything worked. But if Japan ever tightened monetary policy, even slightly, the consequences would ripple across every continent. For decades, analysts repeated the same belief. Japan would never raise rates again. Japan would never abandon yield curve control, a system that capped its government bond yields. Japan would never allow the yen to appreciate significantly. Japan would never risk shrinking the carry trade. And then, in a quiet series of decisions that shocked economists, the Bank of Japan did exactly that. It ended yield curve control. It raised interest rates for the first time in nearly 2 decades. It allowed Japanese government bond yields to rise naturally instead of suppressing them. And these changes weren't symbolic, they were structural. For the first time in a generation, Japan began to reintroduce real market forces into its financial system. This shift produced an immediate and dramatic effect. The yen began strengthening rapidly. And when the yen strengthens, the carry trade cracks. Because if you borrowed yen when it was cheap and weak, but now you must repay the loan when the yen is stronger and more expensive, your profits evaporate. Suddenly, trillions of dollars worth of global positions become unstable. Investors begin unwinding trades. They sell U.S. assets. They sell emerging market investments. They buy yen back to cover their positions. This movement of capital back toward Japan tightens global liquidity. Markets dependent on cheap credit begin feeling stress. And all of this stems from Japan making policy changes it avoided for 30 years. But monetary tightening wasn't the only shift. At the same time Japan changed its interest rate policy, another quiet transformation was taking place inside the Tokyo Stock Exchange. Japan's government pushed corporations to reform themselves, to stop hoarding cash, to improve valuations, to pay shareholders more, and to compete globally. Foreign investors who spent decades ignoring Japan suddenly saw value they hadn't seen before. Billions of dollars of investment flowed into Japanese equities. Companies were structured, cut costs, repurchased shares, and unlocked new profitability. Japan, long considered stagnant and unattractive, became a magnet for global capital rather than just an exporter of it. And beneath all of these policy changes lies an even deeper shift: demographics. Japan's population is shrinking, aging, and retiring. For decades, Japanese institutions invested money overseas because they didn't need it internally. But with pensions to pay, healthcare costs rising, and a shrinking workforce, Japan now needs money at home. As retirees liquidate overseas assets, capital slowly flows inward. The world's largest creditor nation is beginning to repatriate funds. This reversal of direction from exporting capital to importing it is unprecedented in modern financial history. When the world's largest foreign investor changes its behavior, global markets feel the impact immediately. A strengthening yen squeezes carry trades and tightens liquidity. Higher Japanese interest rates make domestic investments more attractive than U.S. treasuries or European bonds. Japanese institutions that once bought massive amounts of American debt now slow their purchases or reduce holdings. This creates pressure on the U.S. Treasury market, pushing yields higher. Higher yields mean higher borrowing costs for the U.S. government, corporations, banks, and consumers. Emerging markets, many of which rely on yen-funded investment, face sudden outflows. Countries that benefited from cheap global liquidity now must operate in a world where capital is more expensive and more volatile. This is the fallout of Japan's shift. For the first time in 30 years, Japan is not providing liquidity to the world. It is absorbing liquidity back into itself. And this is why the shift is so disruptive. Global markets were built on the assumption that Japan's unusual monetary policies would never change. Investors assumed Japan would always maintain zero interest rates, always suppress bond yields, always allow the yen to weaken, and always send capital outward. That assumption has now collapsed. Japan tried for decades to avoid making these changes. It used zero rates, it used negative rates. It printed money, it bought government bonds in record amounts. It bought stocks, it bought ETFs. It tried every monetary experiment possible to avoid revealing the pain of normalization. But eventually, the distortions inside Japan's economy grew larger than the risks of tightening policy. Zero interest rates were suffocating bank profitability. Too many zombie companies survived on cheap credit instead of innovation. Productivity stagnated. Wages stagnated. Growth evaporated. Meanwhile, the pension system began facing enormous strain. Japan couldn't stay in the old system without endangering its future. So it made a historic choice: short-term pain for long-term survival. And here's the part most people overlook. Japan's story is not an isolated event. Other countries are beginning to follow similar paths. The United States is facing enormous debt loads, rising deficits, political gridlock, and a dependence on artificially low interest rates. Europe faces an aging population, slow growth, negative rate history, and structural stagnation. China faces a property crash, demographic collapse, capital controls, and debt burdens that resemble Japan's problems in the 1990s. Japan simply reached these challenges earlier. It wasn't the exception, it was the preview. The data behind Japan's shift makes the story even more shocking. Japan is the world's largest foreign holder of global assets, with more than $3.1 trillion invested overseas. Japanese households hold over $9 trillion in savings, one of the largest pools of private capital on Earth. Japan's national pension fund is the largest in the world, and the yen carry trade, at its peak, accounted for more than 10% of global financial liquidity. When Japan moves, markets move. But because Japan rarely makes dramatic announcements, the world barely notices until the effects are already cascading through the system. This time, however, the silence hides the scale of the transformation. By raising interest rates, ending yield curve control, reforming corporate governance, pulling money out of global markets, and allowing the yen to strengthen, Japan is not reacting to crisis. It is reshaping its financial identity. For decades, Japan played the role of passive, predictable, low-yield, low-growth capital provider. Today, it is positioning itself to become a competitive, dynamic, internally focused economic power. It is the beginning of a new phase, one where Japan attracts capital instead of exporting it, where its currency has real strength, where its corporations create real shareholder value, and where its monetary policy functions like a normal advanced economy for the first time in a generation. The consequences of this shift are enormous. Japan has effectively ended the era of free money, the long period in which global markets could rely on cheap yen to fuel risk-taking. The unwinding of the carry trade poses one of the greatest underappreciated risks in global finance, capable of causing sudden corrections, liquidity shortages, and currency volatility. And Japan's policy changes serve as a preview of what other countries may face as they confront aging populations, rising debt, and the limits of monetary intervention. So here are the three biggest lessons from Japan's transformation. First, the world just lost its quiet source of cheap liquidity. For decades, Japan supplied global markets with low-cost capital. That era is over. Second, the yen carry trade unwind is the invisible domino that could trigger sudden market shocks across the world. Investors who assume the carry trade will survive are ignoring the structural changes that make it increasingly unstable. And third, Japan's story is not merely a story about Japan. It is the warning sign for every country facing long-term stagnation and artificially suppressed interest rates. Japan hit these limits first. Others are next. Japan's decisions might appear technical: interest rates, bond yields, currency interventions. But beneath the technical language is a simple truth. Japan just altered the foundation of global finance. The world may not yet understand the implications, but they are coming, faster than most expect. Japan pulled the trigger. The recoil is on its way. And if you want to understand the next decade of financial shifts, you must watch Japan carefully, because for the first time in 30 years, Japan is not merely responding to the world's economic forces. It is shaping them. If you found this analysis valuable, make sure to like the video, subscribe, and turn on notifications so you don't miss the next deep dive into the global financial system. Because this story is just beginning, and the next chapter will be even more surprising.